Hi, welcome back to the channel. In today's episode, I want to talk to you about what's happening in the Russian stock market because something very important is going on. The Russian stock market has been falling, not just drifting lower, not just having a bad day, it's been hit by a wave of selling. It's fallen to a 3-year low, and some of the biggest companies in Russia are now trading at levels that tell us a lot about what investors really think is happening in the Russian economy. And that's really the key point of today's video, because the stock market is not just a line on a chart, it's a confidence indicator. It tells you what investors think about profits, dividends, growth, risk, and the future. And in Russia's case, that matters even more than it might do in other countries, because the Russian stock market is overwhelmingly a Russian story. If you look at the US stock markets, you've got companies like Apple, Microsoft, Amazon, Nvidia selling products and services all around the world. If you look at the London market, you've got lots of multinational companies with global earnings. But the Moscow exchange is different. It's dominated by Russian banks, Russian oil companies, Russian gas companies, Russian miners, Russian utilities, and Russian consumer businesses. So when the Russian market falls, it's not just telling us something about global investors, it's telling us something about Russia and the Russian economy itself. And what it's telling us right now is really simple. The pressure is building. The official narrative is that Russia has adapted, sanctions have failed, the economy has survived, and the war economy is thriving. But the stock market is telling us a very different story. It's saying higher costs, lower confidence, weaker growth, falling energy revenues, sanctions pressure, labour shortages, inflation, high interest rates, and a war economy. All of that is starting to eat into the very foundations of the civilian economy in Russia. And that's why the latest market fall is so important. The MOEX Russian Index, which is the main benchmark for Russian shares, fell by more than 4.5% in one session and hit a new 3-year low this week. Then, only a few days later, it fell another 4% and hit a further 3-year low. That is not a normal movement. It's not just a bit of volatility, it's a serious loss of confidence. The index is currently trading in the low 2000s and has lost around 12% over the last month and is down by 19% over the last year. And this is not a one-day panic. This is a longer move lower. And the really important thing here is where the selling is happening. The losses have been concentrated in exactly the parts of the market that matter the most for Russia: oil and gas, mining, power, and major industrial businesses. So these are not just small technology businesses that may have blown up in value and are now coming back down. These are the backbone of the Russian economy. Tatneft fell by 6% in one session. AFK Sistema also fell by around 6%, as did RUBLE. Gazprom, the former energy giant that was once held up as the symbol of Russia's economic power, has fallen below 100 rubles per share for the first time since 2009. So that was back when the global financial crisis was kicking in. Gazprom was previously talked about as a company that could be worth trillions of dollars to rival some of the giant US businesses. It was meant to be the great energy weapon of the Russian state. Europe depended on its gas for all of its power stations. The Kremlin relied on its income for taxes, and investors saw it as a cash machine. And now the share price has fallen back to levels last seen over 15 years ago. That tells you something very significant, because Gazprom's problems are not just the stock market problems, they are Russia's problems. Europe has moved away from Russian gas, pipeline routes have been lost or damaged, sanctions have limited the opportunities for new markets, China has not stepped in and replaced Europe on the same terms in terms of buying volumes of gas, and investors are looking at Gazprom and asking, where is the growth going to come from? Where are the dividends going to come from? And where is confidence in the business going to come back from? And at the moment, they don't like the answer to any of those questions. But Gazprom is not the only company in major difficulty. Oil producers are also under pressure. Companies like Lukoil, Rosneft, Tatneft, and Novatek are all exposed to the same big forces: sanctions, discounting, transport problems, drone attacks on their energy infrastructure, weaker global oil prices at certain points, and a state that increasingly needs more money. The final point is really important, I think, because in normal times, investors in big energy companies want profits, dividends, and reinvestment. But in Russia today, the state needs revenue because the war in Ukraine needs funding, the budget needs support. So investors have to ask a very uncomfortable question. Even if these companies make money, how much of that money will actually flow back to shareholders? How much will be taxed? How much will be redirected to the state? And how much will be absorbed into the state coffers? And once investors start asking those questions, valuations start falling rapidly. That is why the stock market is such an interesting window into the Russian economy, because on the surface, Russia can still publish GDP figures and say that the economy is growing and show activity in factories producing weapons, ammunition, drones, tanks, uniforms, and military equipment. But the stock market is asking a different question. It's not just asking, is the money being invested? It's asking, is value being created? And that's where the war economy starts to look much weaker, because building tanks does boost GDP. Producing artillery shells can boost industrial profit. Paying soldiers can increase wages. But a tank that gets destroyed in Ukraine doesn't create a future income stream. A shell that's fired doesn't generate any future productivity. A missile that's launched doesn't improve living standards for everyday Russians. War spending can create activity, but it doesn't necessarily create wealth. And that's the core problem Russia now faces. The economy has been redirected towards war. But the more resources that go into war, the fewer resources are available for the civilian economy. Workers are pulled away from normal businesses. Factories are retooled for defense production. Wages are pushed higher because companies are competing with the military, defense contractors, and the state. And that creates inflation. Inflation forces the central bank to keep interest rates high. High interest rates make borrowing expensive. Expensive borrowing hits consumers, mortgages, car loans, small businesses, construction investment, and corporate expansion. And then the stock market looks at all of that and says, where's the growth going to come from? And that's why the interest rates in Russia is so important. Currently, the rate is sitting at 14.25%. That is extremely high. When you compare it to all of the other developed economies in the world, it is much, much higher. In the UK and the United States, people panic when rates get close to 5%. In Russia, the official rate is still more than 14%. So imagine trying to run a normal business in that environment, or trying to borrow money to expand, or looking to invest into new equipment, or even trying to build houses, finance inventories, open new locations, or develop new projects. The cost of all of that borrowing would be enormous. And the central bank can't simply slash rates because inflation is still materially above the target rate. Russia's inflation target is 4%. The latest inflation data is 5.3%. Now that's lower than it was previously, so it's coming down, but it's still too high, and there are big underlying pressures. Services inflation remains high, wages have been pushed up by this move to wartime economy, labour remains scarce, and the government is spending heavily, and the war is absorbing resources. And the central bank is trying to stop the economy overheating while the government keeps pumping money into the military machine. That's a really difficult balancing act to maintain. And investors can see that. And they can see that the central bank wants to ease its policies, but it just can't do it quickly enough to help businesses. And the economy needs investment, but unfortunately, the borrowing's just too expensive. So investors can see that the state needs its money, but higher taxes and higher borrowing will squeeze the private sector. So the stock market starts pricing in lower future profits. And that's exactly what we're seeing in the prices. There's also the problem with the labour market. Russia still has a shortage of workers. Now that might sound strange because low unemployment is usually seen as a good thing. If you don't have many people that are unemployed, then great. But in Russia's case, it's actually a sign of strain and weakness because they've got demographic problems. It's an aging population. They've got emigration. People are fleeing Russia because they don't want to get called up into the war in Ukraine. They're still talking about mobilization, which is scaring people. You have people pulled into the military because of the higher wages. You've got defense factories competing for workers. You've got civilian companies that are struggling to hire because they can't compete with those higher wages. And when workers are scarce, wages go up. And in normal times, rising wages would be seen as being a good thing. But if wages rise faster than productivity, companies face higher costs without producing more value. So that squeezes their profit margin, which pushes up their prices, which feeds into inflation and makes it even more difficult for the central bank. You get into this vicious circle. So the war has created labour shortages. Those labour shortages have pushed up wages. The higher wages have pushed up inflation, and the higher inflation is keeping interest rates higher. And higher interest rates are hurting businesses and the economy. And all of this is before we even start talking about the sanctions. Sanctions have not produced a sudden collapse in the Russian economy, but that was really never going to happen. The real issue is that the sanctions have gradually reduced Russia's efficiency, flexibility, profitability, and future growth. Because sanctions have made trade more expensive for Russian businesses, they've complicated payments, they can't make and receive payments from certain entities, they've limited access to technology, which is important for businesses to improve productivity, they've increased the reliance on middlemen, the grey markets where Russia's trying to get things through the back door. They've forced Russia to sell its commodities at discounts, the oil and gas and coal and other items. They've reduced access to Western capital. They've made long-term investment harder. Overseas investors don't want to invest into Russia. And overall, the sanctions have damaged confidence. And for a stock market, confidence is everything, because share prices are not based on what a company earned last week. They're based on what investors believe will happen to the company in the future. If investors believe Russia's future is lower growth, higher risk, higher taxes, higher costs, more sanctions, more state control, and more war spending, then they're not going to pay higher prices for Russian shares. And that's exactly what's happening in the market right now. And this is where the 3-year low becomes symbolically important, because Russia has spent years trying to prove that the economy is resilient. And it has been relatively resilient in some ways. It hasn't collapsed yet. The government has stabilised the financial system. Energy revenues have helped. Capital controls have also helped to keep some money coming through. And the state has pumped money directly from the Kremlin. Military spending has created demand. But resilience is not the same as healthy growth. You can keep an engine running by over-revving it. You can keep a patient awake with stimulants or alive. You can keep an economy moving by pouring money into war production. But eventually the strain shows up somewhere. And one of the places it's now showing up is the stock market. The market is saying that Russia's economic model is becoming less attractive. It's becoming more closed, more militarized, more dependent on the state, more exposed to sanctions, more vulnerable to energy disruption, more constrained by inflation, more damaged by high interest rates, and less able to generate normal long-term growth. That's the story behind the share price falls. Tatneft falling is not just a Tatneft falling story, it's a question about Russian oil. Rusal falling is not just about that company, it's about commodities, exports, and sanctions exposure. Gazprom falling below 100 rubles for the first time in a long time, over 15 years, is not just a technical milestone, it's a symbol of how far Russia's energy power has been weakened. And the wider MOEX falling to a 3-year low is not just a bad period for investors, it's a signal that the economic pressure is becoming harder to hide. So the Russian markets are starting to price in the cost of this war, the real cost to the Russian economy. And that cost is not just a military cost, it's financial, it's industrial, it's demographic, it's inflationary, it's structural. And it's the opportunity cost of taking a country's resources and redirecting them into destruction rather than development. Because every ruble spent on the war is a ruble not being spent on modernising the Russian civilian industry. Every worker pulled into the military-industrial complex is a worker not building a normal productive business. Every factory focused on war production is capacity not being used to improve living standards. Every high interest rate decision that's needed to contain inflation is another obstacle for private investment. And every sanction that makes trade more difficult reduces the efficiency of the economy over time. That's why the stock market in Russia matters. It's not just a casino where you can go on and gamble and make money. It's not just traders staring at screens looking like nerds. It's a real-time judgment on the future profits of the biggest companies in the country. And right now that judgment is becoming more negative. The Russian authorities can point to GDP growth, they can point to defense output, they can point to low unemployment or official stability. But the stock market is looking underneath the surface. It's looking at Gazprom without Europe. It's looking at oil companies under severe sanctions. It's looking at miners exposed to global demand and export restrictions, and banks operating in a high-rate economy, or consumers squeezed by inflation, or companies facing rising wages and falling margins, and a state demanding more revenue, and a war that keeps consuming resources without creating long-term economic value. That's the real story. Russia's stock market is not just falling because investors are nervous. It's falling because the economic model is changing. The country is becoming more militarized, more isolated, more state-driven, and more expensive to operate. And for investors, that means more risk and less reward. So when we see the MOEX hitting a 3-year low, we shouldn't treat it as just another financial market headline. We should treat it as a warning light, because stock markets often move before the full economic damage becomes obvious in official statistics. They're forward-looking. They don't wait for the final GDP numbers. They don't wait for the government to admit there's a problem. They react to pressure, risk, and expectations. And the expectation now seems to be that Russia's economy is entering a much more difficult phase. The war economy created a short-term boom, but it also created inflation, labour shortages, high interest rates, budget pressure, and structural distortions. Sanctions did not destroy Russia, but they have made the economy more costly, more restricted, and less efficient. Energy exports haven't completely disappeared, but the loss of Europe and the need to reroute trade have weakened one of Russia's biggest advantages. And now the stock market is putting a price on all of that, and that price is falling. And for Russia, that's an uncomfortable message. The market is saying that the war economy may have kept the system moving, but it hasn't made it stronger. It's made it more fragile. So hopefully you've enjoyed today's video, you found it useful, informative, and most importantly, thought-provoking. If you've liked what I've said, then please give me a thumbs up. Please subscribe to the channel if you haven't done so already. Thank you so much to everyone that's supporting me. If you bought me a coffee or sent me YouTube super thanks or signed up as a patron or a member, thank you for that support. Really do appreciate it. It means a lot to me. It really helps to keep me motivated and making as many videos as possible.